We are thrilled to have Ben Pace here with us today. He is the Chief Investment Officer, I want to get this right, Chief Investment Officer and Head of Global Investment Solutions for Deutsche Bank Private Wealth Management in the U.S. As Ben's role in CIO, he sits on the PWM Global Investment Committee, providing input on the U.S. economy and capital markets. Ben oversees the investment strategy and asset allocation for PWM clients in the U.S. And he brings together PWM's client capital markets and investment capabilities in an effort to provide an effective and consistent experience for his clients. Ben is consistently on CNBC, other news stations, online and on TV, and so you may recognize him. He has a lot of really exciting things to say, a lot of information in this presentation to come, so please get your pen and paper ready, and let's welcome Ben Pace.
Let me just take you through the things I'm going to be talking about. Talking about what's going on globally from an economic standpoint. And while I am a macroeconomic follower, I'm not really a macroeconomist. We have them who support me in the organization. I'm a portfolio manager. So at the end of the day, we look at our macroeconomic analysis and then we put our money where our mouths are with portfolio recommendations for high net worth clients. So I will drill down to talk about the fixed income markets. I'll talk about the equity markets. Admittedly, my first love, because that's what I was before I became Chief Investment Officer, as an equity strategist and equity portfolio manager. The foreign exchange and commodities markets, of course, being a big global bank, I think we have a pretty interesting perspective on what's going on in those markets as well. And then you'll see our investment forecasts. The important notes, more just disclaimers. We lawyers think that they're pretty important. I'm not so sure. But to talk about the global economy, let's get started. And what I'll try to do is take about a half hour, 45 minutes. Laura, you know not what you did by giving me more time. We'll see how that goes. You might have to get the hook. But I do want to open up some questions. But I'm sure a couple of things that I say will be provocative, maybe incendiary. You might not agree with them. But we've got a lot of uncertainty in the world. I guess we always have had, but particularly now, particularly what's going on with fiscal situations in many of the developed market economies and how that progresses and the impact that it's had on markets over the last 4 years and what we think is going to happen in the future. Let me start that when we had the worst recession in our lifetime, right? We had not experienced anything like this since the 1930s. We were looking at letters to see what kind of recovery it was going to be. Was it going to be a V where it came right back? That's great, right? Was it going to be an L, which we've seen in real estate for the last 4 years, where it stays down at the bottom? You've heard W, the double dip recession argument. We're going to deal with that pretty much every summer the last 3 years. We seem to have these summer swoons that make people a little nervous. We took out our mathematics textbooks. I actually gave you the hives when I had to open it up again. But we looked at the square root sign. And while what you see here might not be the true square root, it's pretty close in that you went down so much from the pretty good middle part of last decade to the deep recession here, right? And then when you go down as much as you do, you're going to get your automatic V, right? It comes back. But does it come back to previous levels? Yeah, maybe only slightly. This is world economic growth, not just U.S. But then it levels off, and kind of when you look at the square root, down, up, and across is pretty much what it is. That's sort of where we are. And the concern that we had is what wound up happening. It leveled off at what many would consider disappointing is that recoveries from financial crisis-induced recessions are completely different animals than recoveries from classic inventory boom bust. Just go back to 2001, 2002. We built up an incredible excess amount of technology inventory, worries about Y2K, just really cool products that came out everybody was interested in. And it took a few years to work that off. That was a pretty deep recession in and of itself, right down 2% those years. But once we worked those inventories off, it was off the races. The financial system was okay, the banks were lending, and we had great GDP quarters in 2004, 2005, 2006, some quarters 5%. We've not seen anything like that this time. The best quarter that we've seen is 2.9%, and that is about average. That's about where we should be. Most of them have been disappointing there, and the reason is when you have a financial crisis-induced recession, you have permanent, or it may not be too bad, semi-permanent damage to important systems. I think, well, our most important system is the world financial system, right? The banks, starting in the United States, you could argue that's happening in Europe still, had to take care of their balance sheets. They had to get an idea of what their balance sheets looked like, where their bad loans were, before they were ready to give up any money from a lending standpoint. I'm sure you all experienced certain elements of banks just being out of business for a while. The classic example, of course, was October and November of 2008, when banks were just folding their arms, and they were out of business for about 6 to 8 week period. There was no economic reason for us to recede like this. We weren't fat from an excess inventory accumulation perspective. We weren't fat from an excess human resource accumulation perspective. We didn't have very, very low unemployment rates, but credit stopped working for a 6 week period. My kids call me kind of an economic nerd when I bring this up, but I can't help it. I watch this indicator called the Baltic Dry Freight Index. And what it really is just an index that shows you where world economic growth is from a trade perspective, the cargo ships, right? It was going down in 2008 because the economy was slowing, but it fell to zero in October. It wasn't that economic activity stopped per se, it's that the basic financial instrument of international trade is the bank letter of credit. It stopped being available. So if you can't get the stuff off the ships, you can't get anything back on the ships. And that was going on for a 6 week period. So just, I don't want to bore you with the details, but I was fascinated by it at the time. Scared, very scared. In fact, I'll show you my headshot at the end before the crisis. Not a lot of gray hairs at the end of this, but it's very telling, and it really gives you a sense that credit does make the world go round. That's why we're so nervous, and we were so nervous, particularly last summer of 2011, when S&P came in and downgraded U.S. debt, and had other crises going on in Europe. That Greece in 2011 was going to become Lehman Brothers in 2008, a situation that caused the banks to sit on their hands again. We did not think at the time that it was going to be quite as bad. It turned out not to be. I think those are issues that are still out there. One of the reasons why we've had this subpar recovery. I'll talk about the U.S. a little bit, and I have to talk about the fiscal cliff. I'm kind of getting sick of it, but we're there right now, and it's a struggle we have to deal with. The Eurozone, I'll show you a chart of that. We think that they're in recession. This recession will probably last for a while. But we are excited about what's going on in the emerging market economies. That's a long-term secular story. Nothing is ever straight up. It's going to be fits and starts. There's going to be some downtimes. That is probably, for the people that are getting depressed about what's going on in developed market economies, is going to be a very interesting continual story for us for the rest of our investment lives. And it's not just China. I mean, you can poke some holes in the Chinese story. I will in a few minutes. But it's what's going on in Brazil. It's what's going on even in the Central and Eastern European countries. Peru, if Argentina can only get their act together, right, that would be a very interesting dynamic based on the resource-rich and people-rich country that they are. That's going to be the driver of the magnitude of world economic growth. But what is the most important to the direction of world economic growth is us. And I always, when I come to Europe, I always remind the guys, we are Deutsche, and I'm the ugly American sometimes, but when we sneeze, the rest of the world still catches cold, if not pneumonia, right? And I think we showed that in 2008. So we always start the conversation, even in our Global Investment Committee with what's going on in the United States, from an economic growth perspective, equities, fixed income. And I have the title here, U.S. growth intact, but fragile. And the fragility really comes from what's going on in the government. It wasn't a great recovery in the U.S. Again, it was square root shaped. It's been subpar from a GDP growth perspective, hovering around 1.5% to 2%. Long-term potential growth for a mature economy like ours is roughly 2.5 to 3. Anything less than that, you're going to have higher unemployment rates. Anything higher than that, you might have inflation to worry about if that comes in and tightens. But from the standpoint of consumers who were obviously over-leveraged in 2007, 2008, negative savings rates. Savings rates are back up to 3.5%, 4%. Maybe it's not fully deleveraged, but I'd say 7th, 8th inning as far as that goes. Corporations, never healthier in my career than they are right now. Cash on the balance sheets, low debt to equity ratios, ready to spend, just a little uncertain as to what kind of economic environment they're going to spend into. Right? So, but that I think is a very important thing. Governments, way over level. You see what's going on in Europe when it does come home to roost in the peripheral countries. It's a cautionary tale that we're going to have to watch. Right now, people have no problem buying U.S. government debt, whether they be foreigners, whether they be domestic holders, even at 1.6% on the 10-year, they'll still buy it. But maybe not down the road if we don't do anything about these fiscal deficits, and that's something that we're going to have to, we'll talk about here, we're going to have to deal with over the coming years. The other areas of the economy are okay, kind of I ended with housing. Somewhat, I'm talking about the general housing market, of course not the very high end that you guys are in, but you're seeing it as well. The housing market, which was an L, a 4-year L, is now starting to show some signs of life. The inventory ratios, the months available supply of both new and existing homes have come down from astronomically high numbers, 10, 11 months, down to the more normal 4 to 5 in new and existing. So you could argue we worked off the excess inventories. There's a boatload of pent-up demand for housing. I mean, people hit their 20s, they get married, they start new homes, so that kind of natural process. That's happened. A lot of them are renters over the last few years. So we do think housing will be additive for the first time. I don't want to hang my hat too much on that one sector of the economy that it's about 8% of GDP, the housing-related industries. But at least it won't be a drag anymore. I think that's generally a positive here. The unemployment rates, I didn't update this to this past Friday, down 7.7%. That's not because there was such a great increase in jobs. The labor force participation rate, the denominator, went down. A lot of people were giving up. So that unemployment number, as you know, could be viewed with a little suspicion, but it's been too high. I'll argue that this recession caused another structural issue, though. There is this concept of the natural rate or the acceptable rate of unemployment. When I was learning economics in college, I thought that was obscene. Why do we have a natural rate of unemployment? It should be 0, right? But the reality is there's always someone out of a job because they're relocating. Some businesses are going down while others are picking up. But that natural rate of unemployment is usually around 4% or so. When we had the technology-induced recession in 2001, 2002, those people who lost their jobs were highly educated people. They weren't going to be sitting on any soup lines, right? They might not get the same kind of pay in a new job, but they found new jobs. Think about what the driver of the middle of last decade was, though. It was real estate, right? It was construction. And those construction workers who lost their jobs, they're not as retrained or as able to do new jobs that quickly. It's probably going to take a generation to work them out. The moral of that story is that when unemployment rates get to around 6, that might be a point where it could be a little inflationary. You might not be enough qualified workers for the jobs that are out there. We'll worry about that when we get there. We're still at 7.7%. There's still slack in the labor force right now. That's been problematic. Again, I can't talk about the markets right now without discussing the fiscal cliff. It's so hard to handicap, right? Doing economic analysis is hard enough. The impact it's going to have on stocks and bonds. When you're handicapped in Washington, it becomes real hard. The things I'll say about that is when I say that there's never been as much acrimony as we've seen today, I don't know. I mean, if anybody saw the movie Lincoln, I mean, they were nature of Washington's changed, where the guys and ladies go home on weekends, they don't hang around, they don't get to know each other, particularly the Senate, where they're not showing up on their first day looking to be reelected, right? We're there for 6 years. That kind of collegiality has decreased, and that's become very media-driven, right? You have this fiscal cliff, and I think so many of you have heard what it is, but it's the expiration of the George W. Bush tax cuts that he put in 2001 and 2003. You revert back to the pre-Bush tax cut era, and then, based on the drama of the summer of 2011, you'll have an automatic $1.2 trillion, I'll say this word once, I'll try to get it right, sequestration, meaning spending cuts. Combine the two of those, that's about 4% of GDP. In an economy that's only growing at 2, you do the math, that's recession. In and of itself, again, in an economy that, just like in 2008, we're not fat. We don't have excess inventory accumulation. We still have slack in the labor force. No economic reason to receive, but if this happens, that kind of decrease in government spending, that'll be a lot of job loss. The increased taxes, there's all kinds of economic arguments on what that does to motivation, what that does to GDP growth, but it's generally a negative, right? And so that's what everybody's worried about. At the end of the day, we do think that the adults in the room will get together, but it always is the end of the day. There's no real reason to come to the agreements ahead of time. So what we're going to see, in fact, Speaker of the House, John Boehner, came out this morning and warned his colleagues that they might just be canceling their Christmas plans. That was probably a little drama, just to make the point, but it's probably going to be very last minute. There is a chance that we fall off the cliff. I've increased the handicapping of that chance substantially over the last couple of months, so much so that I've taken money out of the equity markets, worried about it. We thought maybe in the summer 10% probability. Now we have it as high as 35%, based on some people coming out, both parties saying it might not be a bad idea to fall off the cliff, and then at least our deficits will be down. But again, and that seems to be such harsh medicine. As long as we can show that we're making improvements in the fiscal situation, I think that will be better. So what we're thinking is not a full kick the can down the road. That won't happen. There's going to be some compromise. It's probably going to revolve around tax rate increases on the wealthy, and again, the definition of the wealthy is still subject to debate. It's going to be some good faith entitlement or spending cuts. It won't be a lot of them. And then what we'll do is we'll negotiate in March or April to a grander bargain. They're calling this one a bland bargain, and March and April a grand bargain. We'll see what happens in March and April. We think that's what's going to happen at the end of this year, and that the bland bargain will reduce GDP for a couple of quarters by about 1.5%. That's why we're thinking slower economic growth in 2013 than we were originally assuming. We thought we would have had growth at its long-term potential when we came into this year for 2013, and now we're thinking 2%. That's about it because of this issue right now. As far as looking off the U.S., in fact, so many of my talks over the last couple of years started with this because I work for Deutsche, right? People expect me to have a special opinion or insight on Europe. I really don't. I've been discussing this with my colleagues. I've become sort of a half-baked expert on European economics and European politics. You have to be over the last couple of years. But what's happened now is when you have excess fiscal responses to recessions like we had in 2008 and excess monetary responses, people ask me, what's going to be the long-term application? They were asking me first about the inflationary implications of 0% interest rates. That's not so much of a problem right now yet, right? We haven't really seen rampant inflation. But you could argue that the piper is being paid right now for the excess fiscal response. You see it in the European peripherals, they basically run out of money. They can't continue to spend at the rate they're spending. The tax rates are so high, they're not taking in tax revenue because the high earners are moving out of the country, doing business elsewhere. That's the problem that they're running into right now. So you have extreme weakness in, we used to call them the pigs, and that became politically it's still very weak countries, GDP growth of -2 to -4.5%, 5% right now. But Eurozone does have some strength. Right? The northern tier countries are reasonably strong. France, Germany. I used to say Benelux, Belgium, Netherlands, Luxembourg. The Netherlands has kind of fallen off a little bit lately. But you combine it all, and what you're seeing now is Eurozone growth that's going to be flat to slightly recessionary. We're already officially in a recession for the next couple of quarters. You know, it might even be longer than that. Talk about an L-shaped recovery. You go down and you kind of just stay there because of the fiscal issues, the austerity that's going to be necessary. Italian bond yields are at 5% because of Italian economic growth, right? They're at 5% because people are wondering whether the Italians will be able to pay you back. Again, cautionary tale for the United States somewhere down the road that we might have to worry about if we run into the same kind of fiscal situation. That's what's happening in Europe. And I don't want to be too cavalier or blasé about it, but as long as Eurozone doesn't plummet, think 20 years back. The second largest economy in the world at the time, Japan, was about to embark on almost a 20-year economic malaise. And the world economy made it out of it without too much of a problem based on the strength of the United States and the emergence of these emerging market countries who had just come out of planned economies under various forms of communism. That was a very important story, and we still think that will be to sort of offset the weakness going on in the Eurozone here. And here's the emerging markets. I titled this one with becoming increasingly coupled because there's this theory, and it's a pretty exciting one for me as a portfolio manager, around emerging market economies decoupling from the United States, where what happens in the United States doesn't matter as much. That is a nice futuristic concept, maybe 5 to 10 years from now, but right now they're all exporters for the most part. Who do you think they export the most to, right? So the coupling around, you lead with the United States, how they're doing, and then that gives you a better sense of what's going on in emerging market economies is still true. We're the only country with 65% of our GDP, our own consumer, where it doesn't really matter if any other country is in recession. Of course, if you're an industry that exports to those countries, that could be problematic. But from a net economic standpoint, it's not that much of a problem. Where I am excited about the emergence of these economies is 5 to 10 years down the road, the back end of my career, right? Where maybe they start to develop that consumption function in their GDP where they don't care as much what's going on in the rest of the world because their own consumer is generating a good portion of their GDP. And what that could mean, we portfolio managers preach the mantra of diversification all the time, right? But what we know is that that works okay when the United States is all right. The United States goes down, everything's correlated to one, and it's the asset markets, right? But there might be a situation where economic growth is positive in China and Brazil when the U.S. is negative, and you can have different market movements. That's somewhere down the road, but I do think that these emerging market economies are a lot better shape than a lot of the developed market economies, a lot better shape than they were when they first started to emerge in the 1990s. You had peso crises in Mexico and currency crises in Asia. They've gotten through a lot of that. Their fiscal deficits are very low as a percent of GDP. They have not lost monetary policy as a tool, right? You get down to zero and you have to play other kind of games, right? You could argue that the developed market central banks have lost a lot of arrows in their quiver. These other countries can go down 1%, 2%, 3% for short-term rates if they need to. So they still have those tools. I think this is one of the exciting factors about looking at world economic growth and the markets over the next 5, 10, 15 years. I think we've been successful in convincing American clients to diversify away from the dollar. It wasn't easy 10 years ago, but it's become easier as dollar-based assets have underperformed. Now that we've done that, the next thing is to try to convince them to be a little agnostic around, not be so jingoistic about if China wins, we lose. That's fine for wars, right? I think what we've shown from an economic standpoint is that if we can increase world growth, if we can increase the size of the pie, and if you just keep your own share of it, you grow more, right? The Germans and the English still hate each other on the soccer field, but they're not lobbing bombs at each other anymore, right? Because there's a lot of economic cooperation. I think you're starting to see that with China. as much as China wants to be the leader of Asia, will talk tough if we do something, they really don't want to go to war with us, the biggest buyer of their stuff, right? They'll calm down the North Koreans when push comes to shove. Again, I don't want to be too passionate about that. Walking out of the meeting, there'll be something to happen. But I think that those are the things that you'd like to see going on. So you'll see less of that kind of warfare that really hurts world economies, and more economic cooperation and the pie getting bigger. Let me move away from macroeconomics and move a little bit more specifically to asset classes. And I talked about the inflationary implications of the aggressive monetary policies, not just in the United States, but in the other developed market central banks, bringing interest rates down to zero. We're at zero for 4 years now, quantitative easing. And the economics textbooks that I read in school was that should have been inflation. It should have been inflationary 4 years ago. And where's been the inflation? At least in goods prices. You haven't seen it. I'll argue that that's because the concept of globalization, the emerging market economies coming into the world, has made things so price competitive that you don't get price increases if you're a business person. If you try to increase your prices, either a domestic or an international competitor will come in and undercut you. So that hasn't happened. So where's the money gone that's been created? I'll make an argument that they've gone into asset prices over the last 20 years, because we've been easy in the U.S. for the last 20 years. We had a 1990 recession. We went down to 3% interest rates. The 2001-2002 recession, we went down to 1% Fed funds rate. Now we're at zero with quantitative easing forever. Right? They just announced another round of it yesterday, the FOMC. I don't get money is gone into asset prices. Think about it. Stocks in the 1990s trading at 35 times earnings. Real estate, pretty much across the board, particularly mid-level residential, last decade. Certain assets like treasury bonds right now, gold could be viewed that way as well. And this is the asset class that probably scares me the most. Look at it. It's a little blurry, I apologize for that. Look at the 10-year treasury at 1.6% right now. It's got a negative real return because inflation is not zero. It's about 2. It's not bad. That means the real return is negative. People are accepting, for the safety of treasuries, the negative real return. And I think that has more to do with the unnatural buyer that's in the treasury market. One of the tools for quantitative easing, after they got to zero, the Fed usually just buys overnight one day paper to conduct their monetary policy. A few years ago, they started buying 5 to 10-year paper, and they're in there buying the massive treasury issuance. When the Fed, and they will eventually, pull out of that unnatural buying, who's going to soak up that excess supply? You can easily, and probably the natural rate of the 10-year deal should be around 3.5%. That's not going to be because of economic growth. That's going to be just to get rid of the excess supply, right? Price becomes the great clearer whenever you have excess inventory. And if you have an increase like that, that's very painful from a buyer's perspective. I don't want to bore you too much with financial math, but this concept of duration, which is the time it takes you to get your money back when you buy a bond, it's a measure of volatility. When the coupons go down, it takes you longer to get the money back. So if interest rates go up, that hurts you from a principal deterioration standpoint a lot more. So for example, a move 3 years ago from 4 to 4.5% on the 10-year hurts you a little bit. A move from 160 to 225, you can see that's our prediction, hurts you a lot more. So the model there for us is if you're in the fixed income markets in an environment where corporate credits are as healthy as they've been, as I mentioned a few minutes ago, if you're going to stretch for yield, don't do it by extending your maturity. It's very dangerous. Do it by going down credit quality. One of the examples I used was the first quarter of 2012. The stock market was up 10%. But the utilities sector within the stock market, electric utilities, I kind of affectionately call them bonds and drag, because they really don't increase their coupon, their dividends that much, right? Down 3% because interest rates went up in the first quarter of last year. So that's an important story for us, and that's work. And I think while the story is not a new one, it might be getting a little long in the tooth, we think it still has some impact here. And I look at high yield High yield bonds, just like stocks, had this V-shaped situation happen to them. In fact, this is a bad thing. When the yields go up and these prices went down, right? Just like equity prices went down, and then they recovered back to basically average. So if you're brave enough in early 2009, you got 1,800 basis points over the 10-year Treasury. It was great. Now you're back down to about 500, 525 over the 10-year Treasury. But the 10-year Treasury is 160, and you're getting 525 over. That's pretty good compared to 0% cash, compared to bonds that might have negative returns if the Treasury winds up going up. And even though you're back at average, the default rates, because of the strength of the corporations, are only 2 to 3%. That's very low, and they're expected to stay low because of the balance sheet strength. So we think that high yield debt will still be a good performer in your portfolio in 2013. When I got nervous about the equity markets back in the summer and early fall, I didn't put money in cash because cash is only zero. I put it into the high yield space to make a little extra return. And another place I put it, which I think is an even better story right now, is emerging market debt. What happened with the emerging market economies is that they started to tighten their monetary policies in 2010, fighting a true inflationary problem. Inflation in their economies caused by their excess aggregate demand. China was the best example, growing at 10.5%, 11%. That's way too high. You create a lot of excesses, you create a lot of inflation. So they tightened. And one of the old adages we learned earlier in our career is that you don't fight the Fed. When the Fed's tightening, it's a good idea to stay out of the markets. That happened in China, it happened in a lot of the other countries. But they pretty much accomplished their mission. By the end of 2011, they started to ease, and you started to see the, I'll show when I show Chinese equities down the road, the inflation rates coming down. They've started to ease, and now the monetary authorities are friendly. And what's happening is the yield curves are starting to come down, which is just the difference between the short-term rates and the long-term rates. So you're getting benefit by extending duration, which we did. We went out to about 3 or 4 years, and buying local currency because those currencies should continue to go up against the dollar. It's been a nice asset class for us, which we think still has a lot more legs given the strength of these emerging market economies, underlying good fiscal fundamentals. And this is an area that I think will continue to outperform. Another place that we put money, we're a little nervous about the equity markets. Let me move on to equities, talk about that a little bit. I'll start with the United States. The biggest problem I have is that we've been in a 12-year secular bear market. Secular is just a fancy word for long term, right? And it's not that stocks have gone down every year for those 12 years, right? They have. But what has happened is that the amount we'll pay for a dollar's worth of earnings, the price-earnings ratio, has gone down steadily over the last 12 years. Obvious in 2001, 2002 when stocks actually went down. Less obvious in 2003 to 2007 when we had 15 consecutive quarters of double-digit earnings growth. You know, if you're participating in the equity market, you can't nowhere near that in terms, right? So the denominator is growing faster than the numerator in that PE calculation, and that's another sign. And then, of course, in 2008, with stocks going down, but even in this most recent recovery, equities have been they're going up, they're not going up at the rate of earnings, and I have a tough time now. Yet I know that the secular bear is probably close to being over. I just don't see the story to build the terminal point that, hey, it's over, especially with all the stuff that's going on in Europe, with all the stuff that's going on fiscally in the United States, a little bit of a positive about what's going on in the emerging markets, and that could ultimately be the driver, but I'm not making the call yet for price-earnings ratio expansion. We don't think that price-earnings ratios have to get lower. They're down real low, like 13 times right now. But what we're looking at is, give an estimate of GDP growth, 2%. A lot of U.S. companies just don't deal with U.S. end clients, or deal with the world end clients. So world economic growth of roughly 3.5%, 4%. You regain market share there, maybe you grow your top line at 5%. You maintain your margins. Then that means earnings growth is probably about 5%, maybe 6%. And we're just saying, let's just put a multiple on that 5 to 6% growth. That gives you basically 5 to 6% returns in Good news is you add on a 2% dividend, which is pretty good. And that gives you mid to high single-digit returns. Not incredibly exciting, but just like high yield, better than 0% cash and bonds that might have negative returns and do have an increase in interest rates. So not an incredibly exciting story yet. A lot of internal debates about what would cause price-earnings ratios to expand. Still not there. I still have a tough time building that cogent argument that I can confidently tell a group like this to say, go out there and you're going to get 20-25% returns here because you're going to get our year-end target for next year on the S&P is 1,500. We're trading right now around 1,420. There are people out there at 1,575, 1,650, and that is really looking at price-earnings ratio expansion that we're not seeing yet. But it's not a horrible story. Maybe it's the best house in a bad neighborhood. I don't know. You guys would appreciate that analogy. But that's probably not the best way to look at it either. Those are, in a low inflation environment, those are good real returns, mid to high single digits. This year, we're up 15%. It's the worst feeling up 15% in my career, right? Because it's all the bad news. You could really think of it as payback from last year. Last year, we were basically flat. So if you average the two out, it's 7.5% a year. So that's probably a better way of looking at it. As far as European equities, in fact, this is a better example of the price-earnings ratio contraction. Look at September 1999 at its peak. We were in the U.S. in the 30s. Europe got to 25, and the price-earnings ratio, not the stock market itself, what you pay for dollars worth of earnings, continued to come down a whole decade of what we would call the aughts. And it's flattened out here. And maybe ready to move up, but again, we need that catalyst. The one thing I will say about European equities is I'm not as maudlin about them as I am about the European economy. Because don't forget the big, large cap European companies are selling everywhere around the world. They benefit the same world growth dynamics as the big U.S. large cap equities as well. United Technologies and Siemens, for example. Pretty similar companies. One happens to be headquartered in Frankfurt, one headquartered in Connecticut, right? The thing you do have to determine, though, when you get to these markets is what do you do about the currency risk. I'll talk a little bit about euro in a minute or two. But I think that you should have a rating here. We were very underweight European equities. We're normally roughly 10% of our portfolio. We were down close to 5, about half of a rating based on the concern that we had. I got back to less of an underweight. I wish I got back to full weight because this year, this only happened over the past 3 or 4 weeks. European equities in general, as measured by the MSCI European Equity Index, it's higher than the S&P 500. I had to do a double take when I saw that happen. All the negative news going on in Europe, you would not think that that was the case, but it does confirm that the European stocks do benefit more from the world growth dynamics and what's going on in Europe. And you expect the portfolio managers maybe stay away from those sectors that are unduly influenced by European consumers, for example. But I just want to show you what we're thinking about Eurozone equities. China, I talked a little bit about, in fact, I wanted to show you that this is interesting. They were fighting this inflation when they started tightening. Inflation that was going up to 5-6%. They really wanted to bring that down to 2%. And they pretty much accomplished what they needed to do. And earlier this year, they started to ease monetary policy, bringing interest rates down, taking restrictions off of lending. The one thing China doesn't have, they don't have the sophisticated monetary tools that we have in the U.S. and the Europeans have. They literally were holding guns to the heads of lenders saying, don't lend to that sector anymore. Shanghai real estate, for example, because that was getting a little out of control. You could put the gun down and say, go ahead and lend. Those people really have to clean themselves off first before they're willing to do it again, right? So I think that's something that happens that maybe you don't get the immediate reaction. But the Chinese equity market has been a very weak performer, even this year. So I argue that this might be one of the more interesting places. And you could participate in that through an emerging market fund. You could participate in that through ETFs, exchange traded funds, those kinds of issues. But it's not just a Chinese story, but I thought that this one was very interesting for us here. And I have, of exchange and commodities. I started this with is China a currency manipulator? Maybe to be provocative, but maybe to disavow people of that notion. Depends on your definition of the term manipulator. They don't let it flow freely, so it is manipulation at a certain level. But they have let it actually appreciate. That's what this means when it comes down. It means it's actually gone up in value. So they started when they said that they were going to start de-pegging against the dollar. They said they were going to introduce another basket of currencies that they were pegged against. They never did announce what that basket would be. But they've continued to move down. And this has been accompanied by, I used the term secular before for bear market in equities. We've had a secular bear market in the dollar almost at the same time, starting in 2003. It was pretty easy in 2003. You get the currency page of the Wall Street Journal, put it on a wall, throw a dart. Almost every one of those currencies was going to go up against the dollar, right? The developed market currencies, the emerging market currencies. It's not so easy now because all the other developed market central banks are basing their currencies as aggressively as the Fed is. In fact, I would argue that the euro to survive has to go down in value. The yen, the Japanese to get out of their own way, has to go down in value. But we do think the bear market, the dollar, continues to exist, and it's a good opportunity for U.S. dollar-based investors, is in two types of currencies. Emerging market currencies and a corollary to the emerging market story, commodity-based currencies, because the emerging market economies are such voracious consumers of commodities, right? So commodity-based currencies, developed markets would be Australia, Norway, New Zealand, Canada. But what we notice happening when the Chinese do, by fiat, decrease their or increase their appreciate their currency, appreciate against the dollar, those neighboring currencies around them, Malaysia, Indonesia, Thailand, India, Korea, all go up as well. And it's been a great combination story for emerging market equity buyers, right? You got pretty good returns over the last 10 years in local currency in the stock markets, and then you have the currency going up as well. We think that will continue to be a very interesting story, and why we suggest weighting emerging market equities, but also emerging market fixed income as well. And let me talk a little bit about precious metals, because I talked a bit about the inflation in asset prices, and one that concerns me a little bit is gold. And the main reason is that, look at oil. Oil has a central clearing price. There's a clearing supply-demand price that you could argue was roughly $60, $65. Then you add on geopolitical risk premium, because there's always craziness going on somewhere in the world, Middle East, Nigeria. And then recently, the alternative store value premium that oil's gotten because of the advent of exchange-traded funds. It's a lot easier to buy oil, right? In the past, you have to do an investment, a speculator, you have to go out and buy futures. If you forgot to close out the future position, a bunch of oil would be delivered to the doorstep, right? So you didn't want that to happen. Now that you have the exchange-traded funds, it's real easy. So I would argue that there's about a $10 alternative store value premium in the price of oil. Gold is virtually all alternative store value premium. The commercial supply demand, that would be even hard to discern, that clearing price. But when you have a situation where developed market central banks are debasing to the extent that they are, this is the asset that goes up. One thing we've learned, though, over the last 4 years is that when you are more worried about an economic gap down, markets gapping down, a deflationary environment, gold doesn't work anymore. Gold goes down too, right? So I think you have to be careful about it, but in an environment where you are very aggressive in your central bank monetary policies, it looks like you're going to stay that way for the foreseeable future, gold should trend up. And we do have a special allocation to gold. We have an allocation to commodities in general in our portfolio, a special allocation to gold now. We'll probably keep that for a while, based again on the Fed announcement yesterday. I don't know if any of you caught it, that Operation Twist program that they had in the 1960s. That's why they named it Twist. It ends at the end of this month. What that was, they were selling short-term bonds and buying long-term bonds. They're replacing it with just another balance sheet expansion where they're just going to buy intermediate duration bonds again. So instead of $40 billion a month, it's going to be which I think they're really coming close to running out of ours in where it's not really a monetary problem, it's fiscal. But as long as they do that, you want to have some hedge against the ultimate inflation that may happen. Equities hedge you against inflation for a certain period of time. Companies start to get a little bit more price increasing power, but eventually interest rates go up in that environment, bonds get killed. And the way you price any security is you try to get a discount on the future cash flows, right? If you have to discount that at a higher rate, those future cash flows are less valuable to you, and it ultimately bites the equity markets too. We saw that in the 1970s. There are places to hide. You can stay in cash because cash yield might go up, but areas like commodities, gold, one of the reasons why you want to have these in your portfolio, they're very low correlated to the other risky assets. They make a lot of sense just from a portfolio theory argument. And you have a secular bull market in those as corollary to the emerging markets for the last 7 or 8 years, and that should continue. This is noisy. I'm sorry for it. It looks better when I hand it out as far as where we are, economic growth recommendations, world growth 3.1 this year. We just started 2014 estimates. We don't take them as seriously yet because we'll be subject to some revision. We'll start to take this seriously in June and July. For 2013, 3.1% world, 1.9% U.S., recessionary in Europe, slight recessionary nonetheless. UK only 1, Japan really getting out of its own way, strength of these emerging market economies. Inflation, not really a problem in the developed markets, a little bit more so in the emerging markets. Interest rates, Fed, ECB, Bank of England, Bank of Japan, stays loose forever. I don't really mean that, but I'm here talking to you next year, so we have these currencies. We do think that the euro, again, to survive, does not collapse. We do think the euro will survive, but it has to get cheaper. It'll get down to 125 from the current 130, 131. The yen, we've been telling this story about the yen for a long time, and I finally feel vindicated. It was stayed in the high 70s for a long time for an economy that needs to export. It really had to get weaker, and it finally has. It's up to 82 now. I think it'll get weaker even more so. Oil forecast, we think will go up to 100. Gold up to 1900 from, in fact, it's actually at 1700 this morning when I was coming down to see you guys. Our equity targets are mild, 1500, but with a pretty good dividend yield. And same thing for a lot of the other stock markets here. And one thing here I wanted to reiterate is our concern around the 12-month forecast for the 10-year going up to 225, and the total return that retail. It's probably a -3, -4% total return for that issuance. So getting a little nervous about fixed income markets, underweight the intermediate duration fixed income, both taxable and tax exempt. But where we are overweight is U.S. high yield and emerging market debt. So with that, let me stop. Yeah, that's the pre-2008 picture. I'm not going to change that picture. And we'll go from there. Any questions? Anything you want to elaborate on or challenge on? Question in the back? Well, I think it's a good question. I think most of you have a question because you gave it from the back. In a lot of ways, when you look at commodities are hard assets, right? They could be bought broadly by even intermediate net worth investors, and so I want to make sure that I have an asset class that can be bought by most of our clients. But you're absolutely right. Our very high, ultra high net worth, we call them key clients, are doing things like farmlands. I heard this morning, farmland in Australia. We had farmlands in Latin America that we were showing to key clients that were interesting. The island of Lanai, one of the high net worth investors bought. So you're seeing those kinds of things happen. So when you look at real assets, commodities, absolutely. But anything that's tangible in this environment provides you with that inflation hedge. But most importantly, and even if we don't have goods price inflation, you're going to have asset price inflation in an environment where the Fed, Bank of England are all so easy, and you just got to figure out what prices are going to go up. And we think that those tangible assets will continue to be good places to invest as well. The inflationary environment itself, like the 1970s, again, was beneficial to real assets. Housing did reasonably well in that environment because people were getting wage increases, right? I think when they decided to stop the inflationary cycle, because it does ultimately have negative impacts throughout the whole economy, that's when you really had to drive interest rates up really high, slow the economy down. People were worried less about wage increases, more about job security, those kinds of issues. But I think just like the equity market, I view housing the same way, is that in the beginning, you'll be able to get the kind of rent increases if you're income producing to be able to help you offset the inflation. But to the extent that it drives up overall levels of interest rates, it will slow demand for housing, but it will also decrease the present value of those cash flows that you're getting from your rental properties, and it winds up hurting the overall value of the property as well. But I argue that it probably happens in housing after it happens in, say, the equity markets. Yes?
Yes, what factors or indicators are you using to define inflation? Specifically food, fuel, energy, healthcare?
That is a great question. I usually hit that in the talk, but I was looking at my watch, it's gone a little bit too long. So I'll go a little longer. It's a great question, and that definition is so important. And it's so important from the standpoint of looking at what the central banks are doing. Inflation should be defined as an increase in the broad level of prices driven by excess aggregate demand in your economy. So that's why people look at the inflation rate ex food and energy, because it's very volatile, but you really want to see a broad level of prices going up. And that caveat of being driven by the excess aggregate demand in your economy is very important. So for example, if you're Jean-Claude Trichet, when he was running the ECB, the Europeans are so inflation phobic, they remember the Weimar Republic, walking around with Deutsche marks and wheelbarrow days, that they tend to be fight inflation first. But higher food and energy prices, particularly energy prices, were nowhere near being driven by excess aggregate demand in Europe. It was being driven by excess aggregate demand in the emerging market economies. And so for Europeans, the higher gas prices and heating oil prices were more like a tax increase. So to tighten monetary policy into what is a tax increase is making a bad situation worse. Wages were not going up. Because at the end of the day, you can make a really strong argument. The only way inflation can continue to last is that people can afford to pay the higher prices. Right? If wages aren't going up, then that's not happening. So that's important to make that definition, and that's the way we basically define inflation. So the Chinese, the Brazilians, for example, they were fighting a true inflationary problem. And Ben Bernanke's been big that way. So when oil prices were going up, he said, don't worry, guys, that's not real inflation. We look at core. And he looks at core PCE, too, not core CPI. CPI is the asking price of everything, right? It's the basket of goods that's being sold. If you're not buying those goods, that's not what you guys are real estate guys. If you're asking $3 million for the home, that's what goes with the equivalent of the CPI. But if somebody only pays 2.5, that's the core PCE. That's based on actual transactions. That's why he looks at that one a lot more carefully. And he's more concerned still, he was a student of the 1930s, about deflation than he is about inflation. Because deflation, to paraphrase it a little bit, is a pernicious environment in which we have very little experience in eradicating. Right? All the policies that were tried in the 1930s didn't work. The war got us out of that. And a better textbook example is Japan. The last 20 years, all their policies can't not get them out of the inflationary cycle. So his argument is, don't let it happen. We haven't experienced that with inflation. Paul Volcker showed us how to do that. It's painful. It's one of the reasons I had to work in New Jersey for the first 10 years of my career. I couldn't get a job in New York banking in the early 80s because he drove interest rates up to 21%, dropped the economy like a rock. And then again, nobody was worried about price increases anymore, wage increases, just job security. So it's different, but that definition of inflation is very important. That's why when Mario Draghi came in, I was a little worried at the ECB because, being an Italian, soft currency Italian, we all thought that he was going to have to show his inflation fighting muscles. But he realized that she was shaking the wrong thing. Just like in 2008, he was tightening into that economic environment. He was doing the same thing in 2008 We'll take a little symbolism here, right? At least we know everybody's on the same page. But again, I think he understands that any inflation that they see is not being driven by demand in their economy right now. That's more of an emerging market phenomenon. Another question?
I wanted to thank you. This has been fascinating and useful. And while I memorized almost all of it, my brother's a little slower. And I'm wondering if you would make these slides available to us somehow.
Yeah, we could. We definitely could. I think the group has them. Here they have my presentation. I'm sure if these presentations that I pass out, they've all been compliance approved, for example. So we could give you the presentations. Laura, you take it. Okay. But I want to speak for you. Sorry. She's sitting there saying I'm spending it on that's fine. Hey, do I have time for more questions?
Sure.
Okay.
What's the lesson to be learned from what happened in Japan ultimately was a 20-year funk? And is there a scenario where we don't realize that we're in the same boat?
Yeah. It's a good question. The question there is what's the lesson we can learn about Japan? And of course, we all as market participants have to deal with that question over the last couple of years because we're looking a little like that. I think there's geographic difference, right? The island country mentality. The only way UK got away with it is because they created this empire, right? This sprawling empire. Then when they lost that empire, UK has a similar situation. So you have that. I think as much as immigration is a hot political topic, immigration is very important to the development of an economy, right? Because the economy can only grow at the growth rate of your population and the growth rate of the productivity of that population. So those are the two big things. Productivity is a different story, but as you start to mature as an economy, we're seeing it here in the United States, our birth rates are low. We're having less kids, we're having them later. Japan, classic case. I work for Deutsche, right? The Germans are really bad that way. Everybody I know only has one kid, right? And then they go on with their life after that. So that demographic issue has really hurt Japan. Not being able, like we in the United States, by supplementing those jobs people don't want to do to the next generation with the immigration population, who, if you really notice in our history, has, their kids don't do those jobs anymore. The next level of immigrants come in. Their kids go to college. They become more productive employees down the road. That's been a real secret to us. We have so much more in the way of natural resources. Oh, you reminded me, inadvertently probably, look at what's going on with energy here in the United States. We might become, again, another politically charged issue, energy independent within 10 to 15 years. Think of the incredible dynamics that will ensue there. And so we have that natural resource advantage. And I don't want to get too incendiary with this answer, but the Japanese system was very much a rote learning system, a rote education system. They would take our cool technologies, I always use the transistor radio as an example, and they would perfect, right, to where that's what they would sell. But they weren't the idea generators, right? You don't see the great new drugs coming out of Japanese R&D labs. You don't see the great new software products coming out of the Japanese R&D lab. Say what you want about the United States, and I'm very much a defender, I have to when I go to Europe, right? Of our culture, of the fact that we're not necessarily, we do some stupid things we could be, not necessarily in a declining civilization just yet, because of our innovativeness, because we reward entrepreneurial risk-taking, those kinds of things. So there are warning signs that you really have to watch, don't fall into the same traps, but I do think it's a different type of economy. Anything else? Okay.
Since you brought up the energy, I actually did have a question in regards to that. What do you see as the short and long-term effects of really what's political protectionism, the fact that we are fracking is creating more opportunity to create things like exports for LNG, and the arguments are being made both politically and corporately that should be kept unsure in our national energy crisis.
Yeah, it's a good question in that there's a political argument that any extra energy that we produce should be kept onshore, not exported to hold down our prices. And I think, yeah, that's pretty much the way it will start. but the estimates of how much oil is really still available, how much LNG is still really available are quite high, to the point that once we do have a stabilization of prices and prices stay reasonably low, then we're going to be able to start opening up export markets. And we are driven by sort of the capitalistic corporate mentality where corporations should have the freedom to sell their wares wherever they can, right? There'll be some pressure to make sure that they're mainly domestic and that we're not importing as much anymore. But once we get past that, 3 to 5 years down the road, I do think that the energy independence is more longer term. It's not going to be next year, the year after. Then we're going to be exporting. We're going to be competing with the OPECs of the world. There's going to be less petrol dollars floating around because of that. I think it's going to have pretty interesting ramifications for something like the strength of the dollar down the road, but it will happen unless it just gets frozen. You're starting to see those issues in some states. New York, where I am, is a particular issue right now. Ohio, Pennsylvania are opening up. It's still moving north, they go to south.